Hello, good morning or good afternoon, depending what the case may be. Welcome to today's webinar, Personal Investment Plan, the PIP. My name is Frank O'Brien. I am a senior benefits educator here with Westpath Benefits and Investments. And to my right is...
I'm Todd Creviston, and I'm a benefit educator at Westpath.
And working behind the scenes is another benefit educator, Cheryl Hatcher. As we progress through today's materials, if you have any questions, please use the question box, not the chat box, but the question box, and Cheryl will respond with the appropriate answer or resource that is available to you. And if we don't get to complete the questions as we complete the webinar, we will still follow up with any outstanding questions that we have. So, before we get started on the material, just want to remind all of you who Westpath Benefits and Investments is. We are a not-for-profit organization. We are the largest reporting faith-based pension fund in the world. We are a very large organization that supports the United Methodist Church and Methodism throughout the denomination. We have over 100,000 participants. That includes active clergy, retired clergy, lay employees like Todd and myself and Cheryl, as well as surviving spouses and others who would still qualify to receive benefits under our retirement plans. And again, we are a large organization. At any given time, this number is going to move around, but we have about $27 billion in assets under management. And as we go through the session, you're going to hear about certain programs and resources that are available to you. And it's really through that economy of scale that we have that we're able to provide those programs and resources to all of you and to all of us. And what gets us up in the morning truly is caring for those who serve by providing investment and benefit services that honor the mission and principles of the United Methodist Church. For today, we're going to talk about what is the PIP, the Personal Investment Plan. We're going to go through the contribution options. We'll talk a little bit about employer contributions, but we'll spend a little bit more time talking about the various contribution or account types that are available to you to take advantage of the PIP. We'll talk about investing with the Westpath funds, go through the family of funds that we have. I'm going to go through all of that, and then when it gets to accessing your account, I'm going to pass it over to Todd, who's going to talk to you about opportunities if needed. Life happens. You get access to your accounts before you retire and in retirement, and hear about more programs that are available to you, and then we'll go through the resources that are available to you as well. So the Personal Investment Plan, what is it? It is a defined contribution plan. It is technically a qualified 403(b) retirement plan, qualified under the tax law. It is a plan that is able to receive, collect, invest, and grow, and eventually pay out personal contributions, primarily from our payroll, but we'll talk about rollover contributions as well. But also within the context of the Personal Investment Plan, your employer, your plan sponsor, that sponsors your participation in the plan and their participation in the plan, we'll talk about how the employers are also able to contribute to help fund your future retirement income. Now, this is a plan where you get to decide certain aspects of how you want to engage with, and we all hope you totally engage with and embrace the plan to help provide for that retirement income. You decide how much to contribute from your check. You decide how to contribute. So again, we'll talk about the various account types that are available to you. And then how your money is invested. We have the Westpath family of funds. You'll have options as to how you want to invest that money. You'll hear about self-management, where you're just allocating the money according to your own wishes, or a program called Life Stage Investment Management, where we're tailoring that investment allocation for you. But still, it's your choice as to how you want to approach investing in the plan. There are several advantages of participation in the Personal Investment Plan. And one of them has to do with taxes, saving on taxes. It could be saving on taxes now. It could be saving on taxes later, depending upon the contribution type that you decide to take advantage of. Before tax contributions, you're not paying taxes now, it's tax deferred. You pay taxes on those contributions and earnings later. You'll hear about the Roth contribution account, where you're paying taxes now, it's after tax. However, if it's qualified, you're going to be able to get your distributions in retirement coming to you tax-free. And we have Autopilot Solutions. We have a life stage suite of services that has two components. Life stage investment management for your accounts, where we're tailoring the investment allocation for you over time in your investments with Westpath. And then we have life stage retirement income, where you're asking us to tailor from your account balances in retirement the amount of distributions that you can receive on a monthly or annual basis through your retirement. Again, the plan is able to collect employer contributions. They can be in the form of a straight matching contribution, which is the most common. It can be non-matching contributions, discretionary or conditional. It would depend upon how your employer opted to participate on your behalf in the plan. So please consult your employer to get a clear understanding of how that may be structured. We have sustainable investing. We have a range of investment options for you that is designed to have that allocation in place to manage the accounts getting to, into, and through retirement over time. But also our investment philosophy is about sustainability as well, and we'll talk about that a little bit. And then we partner up with EY Financial Planning Services. They provide comprehensive household holistic financial planning services to you, to all of us, at no out-of-pocket cost to you, because the operating expense of our investment funds pays for the use of this service. So this is a service that you can take advantage of that provides financial planning, advice, and guidance for you over time. A service that we highly recommend all of you take advantage of. So there's certain plan information that's going to go into how your employer or plan sponsor decides to set up the plan for you. So there's certain things that have to be set up in what they call an adoption agreement in advance. One is eligibility. There may be a time period or an age for you to be eligible to participate in the plan. How would employer contributions look? How may they work? A thing called vesting, which is basically ownership of the account. And then we'll talk about enrolling in the plan and ongoing contribution election form changes that you're able to make. As far as eligibility is concerned, you yourself are immediately eligible to make employee or participant contributions into the plan upon your hire by that employer. But the employer, for their own reasons, may have some criteria in place to determine when you will be eligible for the employer contributions that could be provided to you. It could be an immediate eligibility for you or based on an attained age. For example, age 21. At age 21, you're eligible for the plan. Could be immediate or a particular period of service with that employer before the employer contributions become available to you. Again, for example, 12 months. Or it could be based on hours of service. So it could be immediate, or there's a number of hours of service that you must work each calendar year to be eligible for the plan. And basically 1,000 hours worked per year means you're a full-time employee. Not necessarily 40 hours a week, but still enough to satisfy the criteria of the hours of service. So again, some of you may have one of these, some of you may be immediate. Again, it can be different across the board depending upon how your employer decided to set that up. As far as the employer contributions are concerned, this is extra money that's going into an account in your name. It's an account balance, market value in our funds to fund your future retirement. There is the employer matching contribution, where you put in 3% of your pay and the employer will match up to 3%. That is a very common approach that employers take, but there are other options as well. It could be a non-matching contribution. It could be that irregardless of whether or not you yourself are participating in the plan, the employer still wants to provide, for example, 3% of your compensation into the plan. So it's not necessarily matched to your contributions, but it's still going through. It could be based on certain conditions that's determined by the employer. It could be discretionary, even though it's a not-for-profit environment. If there's some resources, financial resources available at the end of a calendar year, maybe that could be allocated into the participant accounts. So again, get an understanding of how the employer contributions may be available to you in your participation with the PIP plan. As far as vesting is concerned, it's a fancy way of saying ownership. First and foremost, your personal contribution account, be before tax, Roth, or after tax, or rollover, that is 100% immediately vesting. But employers are also able to put on what they call a vesting schedule to have the account vest and the ownership turn over to you over time. Or, and this is common, the employer just may say the employer contributions going into the plan are also immediately 100% vested, and the employee takes ownership of that. And here again, consult with your employer as to how vesting may be approached where you are. As far as enrolling in the plan is concerned, there's an enrollment packet that should be somewhere within your human resources or payroll department. Complete that paperwork, provide it back to the appropriate resource within your organization. They'll provide it over to WestPath. We'll get everything set up, and then your contribution processing can begin. And then from that, once you get enrolled into the plan, you then have access to our web portal called Benefit Access. So benefitaccess.org would be where you would go to register for an account, and then you can see how your accounts are allocated, what investment funds you're in, making sure that the dollar amount or percentage that you elected is going into the plan, and over time see other activity that is happening within the context of your retirement plan. One key element is beneficiary designations. Make sure they are set up on your record, and you can see those through Benefits Access. Ongoing, you've already enrolled in the plan, but ongoing, things change. You want to modify the amount that you're putting into the plan, hopefully more and more over time. But again, life happens. Sometimes you have to back off a little bit for a period of time. You would use that form to elect a before-tax, Roth, and/or after-tax contribution. You can say, I want 4% to go into before-tax and 3% to go into Roth. That's fine. Overall, 7%, but how that gets allocated can be managed on that form as well. You can decide to do a percentage or a dollar amount, and that is fixed. You can do percentage or dollar amount. But Todd and I and others will say you really should try to do a percentage, because you may not be able to necessarily, quote unquote, put more money into the plan, but if you do get a pay raise 1 year over the next, or whenever you get a pay raise, on a percentage basis, you know more dollars are going to be going into the retirement plan just by virtue of how the percentage against that higher compensation will work. Again, you can increase it and decrease it at any time. There may be an internal process that's in place at your employer, but it should take a matter of days or weeks at most before a change would be made. So the contribution accounts and certain things to be considering as you take a look at these and participate, engage in with these contribution accounts. First, there's the before tax contribution, and the words are kind of telling you what's going on here. You get your, I'm going to say monthly pay. You get your monthly pay, either that percentage or dollar amount has been determined as to how you want it to contribute. For lay employees, FICA taxes will be taken, and then that determined dollar amount will be deduced from your paycheck and gone into the to the PIP plan, and then any other federal and state taxes will come through. If there's anybody here that's a member of the clergy, the SECA taxes come out after your contribution calculation is complete. The contribution goes in tax deferred. It's not taxed yet. It's before tax. The earnings on it over time, when it comes out in terms of distributions, or more importantly, retirement income, that will come out as taxable as ordinary income. Then there's the Roth contribution. This is an after-tax contribution. So we get your monthly payroll amount. We determine the amount that's going to be going into the Roth plan, but we don't do anything with it yet. We take FICA or SECA taxes, federal, state taxes, all that comes through. And then we take the calculated dollar amount and put it into the PIP plan. So it's after tax. But what you have done is you have front-loaded into the Treasury, if you will, those taxes. And so the benefit of that is if you qualify the account, which is an easy thing to do, if you qualify the account, then your distributions will come out in their entirety tax-free in retirement. So how do you qualify a Roth account? Well, the first thing is you have to be over age 59 and a half. It's a magic number in the retirement world, but basically this is a retirement account intended for retirement income. So over age 59 and a half. And then the second is the very first contribution has to age up 5 years. So it needs to be 5 years old or older, and you have qualified the account. It's not each contribution or each year's contribution. It's just that very, very first one, ages up 5 years, you're over age 59 and a half, and your distributions can come to you tax-free. If you're in a Roth account and you have disability or a death, then that also becomes available to you as a qualified distribution. And then we have the pure after-tax contribution account. Don't really see a lot of activity with this these days because of the Roth contribution account, but the next slide will indicate an opportunity for those to take advantage of the after-tax contribution account. But this is pure after-tax. You get your pay, and then any taxes that come through, FICA, SECA, federal, state, all of that, all those taxes go, and then the dollar amount will go into the PIP plan. Those contributions will not be taxed again, that's double taxation, but the earnings in that contribution account will be taxable upon distributions either before retirement or certainly in retirement, they remain taxable income to you. So if you're thinking about after tax, talk to EY Financial Planning Services, your own financial planner, to test it against the Roth contribution as opposed to the pure after contribution account. But again, the after-tax contribution account can come into play for those who exceed the contribution dollar limits that are provided each calendar year. So as I said, it's a defined contribution plan. One of the things that's defined for us through the IRS by law and regulation is how much can you contribute on an annual basis to these accounts. So here you can see, if you're under age 50, the Roth and before tax. Okay, I'm talking about the Roth and before tax contribution accounts on a combined basis. You have $23,500. You have a catch-up if you're between 50 and 59 of an additional $7,500, gets us to $31,000. For those 60 to 63, there's a super catch-up. It's actually $11,250 for that calendar year. Then it's $34,750. And then at age 64, it reverts back to the regular catch-up contribution, and you can see that there. So for those of you who have an opportunity, yourself or as a household, to actually exceed these limits going into your retirement plan accounts, then you can take advantage of that after-tax contribution account and continue to contribute throughout the course of the calendar year. Even though your Roth and or before tax has hit these limits, you still have the ability to put more money into the plan. The PIP plan does accept rollovers. Rollovers are prior employer retirement accounts or a traditional IRA that you are able to roll over into the PIP plan and have it get invested with however your personal contributions are going into the plan. Again, it has to be a qualified plan, so 401k, 403b, 457 governmental plan, traditional IRA, unfortunately not Roth IRA, can come into our plan and your account. We have an incoming rollover form that you complete. You send it into WestPath. Cheryl, who is with us today supporting this webinar, is also responsible for the rollovers. She works with your current employer or custodian of that account and does a direct rollover behind the scenes. It comes into your PIP plan account as a rollover contribution, and it's there aggregated with all of your retirement contributions in our funds growing over time. Before you decide to do a rollover from your prior employer or a traditional IRA, have that conversation with EY Financial Planning Services or your tax or financial advisor just to make sure you understand what the consequence of that would be, how it would work, how it would look for you in the here and the now and over time. Then we'll talk about investing your plan. So just to slow down for a moment, we've talked about getting enrolled in the plan and the eligibility, and now you're in the plan. You've thought through and worked through what types of contributions you want to contribute into the plan, before tax or Roth, a combination of the two, whatever may work for you. You have a prior employer plan. You don't want to leave it over there, so you bring it in as a rollover. Now you are investing in the WestPath funds. And there are several benefits of investing in the WestPath funds. As I said earlier, we practice sustainable investing. Now, sustainability to us means two things. One is sustainability over the long haul. We have been around for 118 years or something like that, have provided, continue to provide, and will continue to provide retirement services, benefits, and retirement income to the participants at WestPath. But also sustainability gets to our philosophy of investing. The environmental, social, governance principles that comes into how we invest and with whom we will invest. Certain industries that we will not participate in tobacco, alcohol, firearms, pornography, etc. And then certain sovereign governments for whom we will not participate in the purchase of their sovereign debt or letting them lend to us their sovereign debt because of their human rights practices that we disagree with. So in having that philosophy, sustainability really means two things: making sure it's there for the long haul, but also upholding the values of the church. We have a diversified set of investment options that I will review with you. Diversification is a key to long-term investing as you're participating in certain segments, many segments of the marketplace over time. We have competitive returns relative to benchmarks. Even though we kind of are our own entity within Westpath and the denomination and supporting organizations that we have, we still make sure that the fund performance that we have matches up with the quote-unquote marketplace. So if we have a U.S. equity fund, we want to know how the U.S. equity funds across our peers are working. Same thing with bond funds. We want to make sure that our investment managers behind the scene are working correctly within the context of the market so that we are experiencing the returns as the broader market is experiencing those returns. We have low expense ratios and no commissions. No one at Westpath gets a commission for bringing in a new school or a new hospital system or anything like that. We don't have anything that runs along those lines. And because of that, we're able to keep the assets within the context of the investment funds for all of us to enjoy. And by having that, we're able to have that economy of scale where we can have low expense ratios. How much does it cost to be in those funds? From like 0.24 to 0.79%, where that expense ratio is what comes out and pays for the overhead of Westpath. So again, some of the programs that you'll hear about are taken care of, and EY taken care of because of how we structure the expense ratios. And then there's life stage investment management. And we'll talk about how that comes into play after we review the investment funds. And I'll go through this quickly. We're going to talk about these by types or asset classes that we have. We do have a short-term income fund called the Stable Value Fund. This is a fund that would get used later on in your career and certainly in retirement because it's a fund that has a very, very, very low risk ratio and has a very, very low rate of return. But that's on purpose because it's a capital preservation fund. It's intended to, in effect, not lose money. We have income funds or bond funds, or bonds, debt instruments, where we're taking on the debt of others and they're paying us back over time. We have inflation protection fund. This is a fund that actually invests in Treasury inflation protected securities called TIPS, where the idea of the performance is to keep pace or even outperform domestic inflation in the U.S. economy. We have a fixed income fund. This is a broad range of funds that gets into various types of bonds, bills, and notes that we have through Treasury, corporate bonds as they get released by certain corporations, and also sovereign bonds from other countries, but again, with our screening in place, others, and then also international companies that are also floating bonds to generate some revenue for themselves for their business build out. So that is in that. It's a very large fund that we have. And then we have the Extended Term Fixed Income Fund. This fund is actually a fund that is on what they call the long end of the bond market. So we're really focusing in on those 10-year bonds and those 30-year bonds that you hear a lot about in the media. Nobody knows what inflation and returns are going to look like 10, 30 years from now. So this is what they call a risk premium in there. So still a fixed income fund, but it has a little bit more risk exposure and a little bit more potential rate of return as a result. And then on this page, we'll bring it down to the bottom first. We have our equity funds. We have the U.S. Equity Fund. That is a fund that the words are telling us we're purchasing domestic U.S.-based companies, the large companies that you hear about in the media all the time, as well as mid-sized companies and small-sized companies. Companies that are in the growth spectrum right now, and companies that the professionals think are value organizations, where they're underpriced now and they're purchasing now thinking they'll get to what they believe to be their actual price, and we'll go along for the ride with those gains. It's an equity fund. It's a high-risk type of fund by virtue of the asset class that we're talking about. We have the U.S. Equity Index Fund. This is another fund with a broad array of U.S.-based companies, but we're using the Russell 3000 Index as a gauge and barometer to make sure that we're investing as the Russell is investing, that we have it weighted correctly, and then that we are getting the returns that the Russell 3000 is also returning. Now, we still maintain that we have the screenings involved, so we may not be all of the companies in the Russell 3000, as we might screen some out, but that is the concept for that fund. And then we have the International Equity Fund. International, so it's still a company stock fund, but they're not U.S.-based companies, they're international companies, so Siemens and Sony and those types of companies where, again, very large companies that we've heard of, like the ones I mentioned, mid-sized companies, small companies, what this growth companies, this value idea that I talked about, where it's going to come up in price over time, that's all in there too. It's the highest risk fund that we have because international equity has the highest amount of risk because it's not just company risk at that point in time. You can have currency risk, geopolitical risk, and those types of things. So you'll see a scale momentarily that kind of outlines that as well. Then I'll bring you back to the top. This is what's called our multiple asset fund. It's a balanced fund of stocks and bonds. So you're getting that baked-in diversification of stock exposure or equity exposure, the bond or fixed income exposure. You can see 65% is in equities, 35% in that fixed income environment. But this fund has a charter to kind of maintain those percentages over time. Not a bad thing. It's a good thing for long-term investors. You're going to get that diversification in the market. But when I talk about life stage investment management, you'll see how that program differs a little bit from the balanced fund approach that you can see here. And then lastly, this is actually getting back to our sustainability philosophy of investing. We have these three funds here, 2 fixed income funds and 1 equity fund, and these are for participants with a heightened focus on a company's environmental and social performance. So here we have those screenings in place, but there's certain annual conferences or agencies or other large areas within the denomination where they really want to look at what we're investing in and maybe do a little more carve out and have that heightened focus on this environmental and social performance. So you can take a look at that. If you're inclined to invest in that way, we have those funds available for you as well. Here's a quick look at the risk and potential return measure as I kind of went through the funds. You can see on the left-hand side the stable value fund. Again, it's a capital preservation fund, not really intended to make a lot, so it is low risk, low potential rate of return. The fixed income funds there in the green, you can see there's some elevated risk as you go into the various funds that we have, but with that elevated risk, you have an elevated potential rate of return. And you can see how that would work over time. The multiple asset fund sits in the middle because it's built by equity and fixed income funds, and then the equity funds are the ones with the highest risk, international being on the top right, but also the highest potential rate of return. Now, these are long-term historical performance views on this slide, because as we know, at any time it can go topsy-turvy and things can kind of perform differently for hopefully a short period of time. But as markets normalize back to their normal trend, this is what you would see over the long haul. And remember, retirement plan is a long-haul proposition. As I indicated earlier with choices that you have when you're in the plan, you can choose to self-manage. We've quickly gone through the funds. You have resources available to you to learn more about the funds, and you can self-manage. If you're comfortable with that, comfortable with the asset classes and all of that, you can do so. Or I'm going to talk to you next about life stage investment management, where we're taking a subset of our funds and doing the allocation for you over time. Either way, we believe it's important for you to continue to reach out, not every day, but periodically, to EY Financial Planning Services, just to take a look at where you're invested, how you're invested, what may be going on in the economy, nationally, internationally, and all that, just to get a level of comfort over time as to how the accounts are allocated for you. And then my last segment is to talk about this life stage investment management program. It's a personalized investment management tool for your defined contribution accounts. We set an asset allocation, and then we review it quarterly, and I'll go through that. And we rebalance that allocation as we review it quarterly over time. And it manages the investment during your active service and in retirement. So you go in retirement, you stay with us, you're receiving your retirement income from your accounts, and you're in life stage, that will stay in play for you. The way it works is we look at you in a particular point in time and we say, all right, you're 50 years old, you have a moderate risk tolerance, we had you set up at, let's say, a 70-30 allocation percent, and our equity funds is that 70%, and our fixed income funds is that 30%, okay? As we age up, the amount of that equity exposure slowly and subtly comes down, the amount of that fixed income exposure slowly and subtly goes up, because as people are getting closer to retirement, we want to reduce that amount of equity risk, we want to increase that amount of fixed income, we want the risk for growth, but as people getting into retirement, we want to make sure we have a foundation that we can provide those monthly benefits for you. So as you age up, we're going to continue into and through retirement to balance that allocation. But we also look at you 4 times a year on a quarterly basis, but it's based on your birthday. So it's not January 1st and April 1st for everybody. We look at your birthday, and quarterly over that we say, hey, we want you at a 70-30. Market's been rallying, you went to 80-20. Sounds good, but that's not where we want you. We want you at that 70-30. Or the economy's gone the other way, and the bond market's rallying. Now you went to 60-40. Again, maybe not bad, but that's not what we want you. We want you at 70-30. And because we are actively managing your account on a regular basis while we're doing that long-term glide path, I'm able to say that there's a potentially higher internal rate of return from your investment portfolio with our funds because we're actively managing in the short term as we are continuing to manage in the long term. The end of it is we're creating a diversified investment portfolio customized for each participant. Part of the things that we're looking at to get that allocation in place is what is your age, potentially if you're married, what's your spouse's age, your expected benefits commencement date. So we'll default that to age 65, but if you plan on working to 68 or 62, you can let us know that. This idea of risk tolerance, basically how comfortable are you investing in the markets? Moderate investment, okay, you can take some risk, you're okay with that. Some people are more conservative because they're not that comfortable with market activity. Other people, they're okay with it, especially at a point in time where you have a long runway to retirement. You might be aggressive and take on more of that equity risk exposure over time. But you can determine where you're most comfortable being, conservative, moderate, or aggressive. And then we assume Social Security benefits as we set up the allocation as well. Thinking about other streams of income coming your way. For those of you who may not know if you're self-managing or if you are in life stage investment management, but contributions are coming in and getting allocated, we have defaulted you to life stage investment management. So here we're going to take that middle of the road, moderate risk tolerance. We're going to say your benefit commencement date is age 65, but you can tell us and set up yourself on Benefit Access when you think your retirement age is going to be. And then again, for laity, we're certainly saying eligible for Social Security benefits, but for clergy, we are assuming Social Security benefits unless we are told otherwise. You're going to hear about resources momentarily, but there are resources available to you around our investment funds on westpath.org. These funds, there are personal funds, privately managed funds, but they look and feel a lot like mutual funds. So they get priced on a daily basis. You can see the daily price on westpath.org. You can get fund descriptions. You can get very high-level executive summaries of our funds, or you can get very deep prospectus so that you can see exactly how it's set up, what our top holdings are in that fund, all of that. Certainly available to you. When you speak to EY, your advisor, take advantage of that. Again, we benchmark. We want to make sure that we have comparative results. And you can see what our fees are, okay, those operating expenses for each fund. You can get that information available to you at westpath.org. So, you've enrolled in the plan, you've determined your contribution type, that money's coming through, maybe you rolled some money in, now you've got yourself allocated either self-managing or using life stage investment management, and then life happens, and this is what I'm going to transition this over to Todd to talk about accessing your accounts from the PIP.
Thank you, Frank. Well done. So you're enrolled in PIP, you're making contributions, and you're wondering, can you get access to your money? Well, ultimately, what PIP is going to do is help you save for retirement. But as Frank mentioned, sometimes life gets in the way. So you do have the ability to take a distribution from your account or a withdrawal for a variety of reasons. We just want to comment that if you access your account like this before you retire, it may impact your financial security in retirement. So the two calls that we recommend you making would be to Westpath Participant Solutions. They'll be able to walk you through the various reasons or ways to take a distribution, and you can also have that conversation with EY. And here are a list of the reasons to take a distribution prior to retirement. Runs from a hardship loan, hardship withdrawal, and again, we're not going to get into all of these details. Some have a penalty, so it's important to know what the tax consequences are and what the plan consequences are, and that's why we recommend, if you're in a situation where you think you need to do this, have a conversation with EY and or Westpath Participant Solutions. Now, in retirement, so this is what we're saving for. When we talk about distributions in retirement, we're talking about replacing your working income. And our first opportunity is what's called cash installment or a monthly distribution. This is designed to replace a portion of your paycheck. And there are two ways to do this. The first is called self-managed retirement income. Self-managed means you get to decide. So you determine how much you'd like deposited in your account each month. You don't have to worry about running down to the mailbox to pick up a check. All of these transactions will happen via electronic transfer. So you'll indicate how much you'd like to have in your account each month from your PIP account. And this can change over time. With the account balances like this, you have flexibility. You can start it, you can stop it, you can change the amount, okay? The next opportunity is called life stage retirement income. And life stage retirement income has been around for a while. It's been here longer than me. I started in April of 2012. Life stage retirement income was originally designed to calculate a payment for you from your account balances. And it's actually won industry awards. And it actually, since its inception, has got more sophisticated. And I'll talk a little bit more about those additional optional features in a little bit. But life stage retirement income is designed to calculate that payment for you. We've spent a lifetime investing and earning and making contributions to PIP. A lot of times it's difficult to switch from that saving, investing, paying off bills mode to retirement mode of taking that distribution. Life stage retirement income can ease you into that. You can also take a partial lump sum, so you can roll out $10,000, $15,000, so a portion of your account. You can also roll it out as a lump sum, so you can roll out your whole account balance. When we hear about participants doing that, we always want to make sure that they have a conversation with EY, because there could be some tax consequences with that lump sum rolling it out. And if you're clergy, you'll likely lose the housing allowance exclusion associated with that money. So it's important to know that up front and use that information to make that decision. The next opportunity, if you don't need the income when you retire, you can leave it on account invested with Westpath until RMD. RMD is required minimum distribution. It's an IRS term. It's essentially the time that the IRS will require you to begin taking distributions from your cash account. That would be your PIP account, or even if you have a traditional IRA. And then another important feature is that you can actually take a loan from your UMPIP account, maybe for a down payment for a house, maybe to cover other medical bills. If you're in that circumstance, we recommend that you have that call with Westpath Participant Solutions as well as EY to help explain what that process looks like. So now we're going to talk a little bit more about life stage retirement income, spending your retirement right. So moving into retirement, life stage retirement income, as I mentioned, will calculate a payment for you from your account balance. Life stage retirement income actually won several financial awards for the product. Life stage retirement income each November, it will recalculate your payment in November. you'll be notified of that payment in December, that amount, and then that will begin January 1. The goal is to provide an annual adjustment up based on age and investment gain and loss, but based on those market conditions, it's possible that you might not get an increase, or you might just get a smaller increase. When you're using life stage retirement income, the funds associated with that life stage retirement income payment, those funds will be managed by Life Stage Investment Management that Frank explained a little bit ago. And just as a reminder, the goal is to provide that monthly payment for participant and survivor's lifetime, and then make those adjustments up accordingly each November. Life Stage Retirement Income provides flexibility and choice. You can actually determine how much of your account balance you want to be used in that life stage retirement income payment. You can also add additional money to that. One way would be through a rollover. There's no direct participant costs. These expenses are paid for through the Westpath budget. And I mentioned earlier, there's two other features, or there's life stage retirement income over time has gotten more sophisticated, and there was two features that were added in the spring of 2022. The first one is the Social Security Bridge, and the second one is longevity income protection. And that Social Security Bridge is designed to provide you the money that you'd receive from Social Security. That money would come from your life stage retirement income payment. And the reason for this is that Social Security Bridge, if you use the Social Security Bridge, you'll be able to delay taking Social Security. So everyone has a full retirement age. My full retirement age is 67. So that means I'll receive the largest benefit at 67, as opposed to taking it early. Each year I delay taking Social Security, that benefit increases by about 8% per year. So if I delay from 67 to 70, the benefit that I'd receive at 70 is about 24% bigger than my 67 payment, my 67 benefit. But between 67 and 70, I'm going to need a little bit of income, and what that Social Security Bridge does is provide your Social Security payment, that amount from your life stage retirement income payment. So you're whole. You're not going without, you're just getting the money from a different spot. The longevity income protection is a deferred annuity, and you'd purchase this from an outside vendor that Westpath has chosen. You'd purchase that at retirement, and then that longevity income protection is an annuity. That payment would begin at the age of 80, providing a steady stream of payments over the participant, and if the participant is married, over the participant and spouse's lifetime. And here's an example of how it works. So in this example, we've set up the Social Security Bridge and the longevity income protection. They're both optional, and you could do one or the other or both. In this example, it's doing both. So with life stage retirement income, retirement begins, let's say this is when I turn 67. This payment includes the life stage retirement income payment, but it also includes what I would have received from Social Security as that Social Security Bridge. And then at 70, you'll now see that life stage part of the graph is lower. It's about half of the payment or so. So when Social Security begins, your life stage payment gets leveled down, and you'll actually see that there's a net increase in the income that you're receiving because that Social Security benefit has grown because you deferred it beyond full retirement age. At 80, you'll then see that life stage retirement income payment decrease even more, so saving that account balance for the long haul. Longevity income protection, that deferred annuity has begun, so this is 80 years of age and beyond, and then Social Security is layered on top. So now let's talk about some participant resources. This is a screenshot of Benefits Access. And when you log into Benefits Access, you will be able to see all of the benefits that are available to you from WestPath. In this example, the far right-hand side, that little logo, that is the Benefit Access login page. If you haven't registered for Benefits Access yet, all you need to do is scroll down a little bit and it'll say New User Registration. You'll click that and follow the steps to create your account. In Benefits Access, you'll be able to check your account balances. All of the quarterly statements are generated and posted there for you so you could see what those milestones look like. A terrific tool and resource is that benefit projection tool. So you're able to go in and project what your benefits would pay at different moments in time into the future. You're able to review all the investment information. An important piece that Frank also talked about was your beneficiary designations. Make sure your beneficiary designations are up to date. Make sure that they are going to pay out the person or persons that you currently want them to. WestPath will pay out those beneficiaries based on how they're listed in Benefits Access. So if your will and Benefits Access aren't synced up, make sure that you align those. And then there's tons of educational resources. So do this in advance. You'll designate who receives your benefits. The plan defaults are typically your spouse or your estate, so that would be your primary beneficiary. And then children or heirs or an estate would be considered secondary. So make sure that you go in and update that. Quarterly statements, you'll be able to find all the quarterly statements. They're all posted in your account. They're under the account title in Benefits Access. But you're also able to view your current account balances. Frank mentioned that all of the funds are traded daily, so the prices typically change each day. You're also able to verify your transaction details, including your contributions, but if your employer has a contribution, and you're also able to see the rebalancing that Frank talked about with the life stage investment management, rebalancing as needed. You'll be able to see that listed there. EY Financial Planning, their phone number is listed there. The EY Navigate website is also a terrific resource. And this is confidential financial planning. I also like to explain that not only is it confidential, and these are professional financial planners, there's no judgment. There's no judgment. And I've had conversations with clergy that might have had issues with debt or might not have been in the best financial place. And my recommendation was call EY, they can help. They're here to help with this exact situation. And I've heard from a couple of clergy say, oh, no, I'd like to get things cleaned up first. I'd like to fix it. And what I'd like to implore is there is no judgment. You know, when I go to the doctor, I know that I'm going to my doctor annual visit. So what do I do before that? Well, I exercise a little bit more. I eat a little bit better. I make sure that the scale's a little bit lighter, right? So that there's no judgment from my doctor. I've heard clergy say the same thing about EY. And having communicated with a number of EY financial planners, there is no judgment. Call them, they can help right away. There's no sales pitch. It's objective guidance. They don't get paid based on the guidance they provide. They get paid a salary for doing a great job and working with the participants. EY has been our financial planning vendor for about 18 going on 19 years. So they are well versed in all the plans, all of the plans, all the funds, but they also understand taxes and other parts that go into that whole financial planning picture. There's no need to enroll. You could just use that 800 number there and call them up and get a session started. You can also go to that website and create a username and password. is a ton of information in that website, and it's well worth the 5 minutes that it would take to set that up. Consultation topics, really nothing too big, nothing too small. They can really create a comprehensive retirement plan. The plan that they provide is impressive. I would suggest that everybody give them a call and get that started. But they can also help with an easier question like, should you choose Roth contributions? Or is there a point in the future where you should switch to Roth contributions? So they can really work with that concept. They can also talk you through life stage investment management. If you're trying to fund your PIP account, but also trying to save for a child's education, that's a great topic, as well as managing debt. So really, no question too big, no question too small. You can look for more EY webinars by going to westpath.org/events, and you'll be able to see those as well. If you sign up for EY Navigate, you can also sign up to receive their monthly newsletter. With that monthly newsletter, they also promote 30-minute essentially webinars on different topics, from taxes to Roth contributions, should you buy a car or lease a car. So a variety of financial planning, kind of like the financial well-being aspect of it. You can also sign up for a one-on-one consultation. It looks like our link is a little bit dark there. It's westpath.org/, well, I'm hoping everybody could see it. We'll make this a little bit more obvious when we send this out, and we'll send out a PDF version of the slides. But it's essentially what you're able to do is sign up for a consultation with a benefit educator. They typically last 30 minutes. That link will take you to a website called Sign Up Genius. You'll pick your date and time of your appointment. Within a day or two of signing up, you'll receive a Microsoft Teams meeting from the benefit educator that's been assigned to you. And at the date and time, you'll log in, the benefit educator logs in, we secure the call, and then we share your benefit access screen, and the floor is yours. We can answer all your questions. If we run out of time and need to schedule another one, by all means, we can schedule as many as needed. Another resource would be Westpath Participant Solutions. They are a great group of folks, and they are accessible at that phone number there. Most of our webinars conclude with an action planning or a to-do list. This isn't necessarily a get this all done today list, but it's likely in the order of importance. If you're currently not enrolled in PIP, we encourage you to do as quickly as you can, okay? And then when you're enrolling, you're going to choose how much to contribute from your paycheck, okay? Before tax, after tax, Roth, if needed. That's a great conversation with EY. If you are already enrolled, we still invite you to log into your benefits access account to double check how much you're contributing, and then maybe consider increasing that if possible. This is a great opportunity to save for retirement. We know Social Security isn't going to be enough. PIP will help to create a robust retirement. Determine your investment strategy. Are you somebody that's going to go it alone and self-manage, or will you use life stage investment management? Approximately 80% of the individuals who are eligible for UMPIP are using life stage investment management. So you'd be in great company with that. And then schedule that one-on-one with a benefit educator. Call EY to review your plan. I like to say when you first call EY, it'll be kind of like going to the doctor, right? They're going to ask you some questions. They want to see your history, what your goals are, what you want to save for, how much income you have coming in, and then what you've done so far, so that they can help guide you to that successful retirement. That concludes our webinar today on PIP. Thank you for joining us today, and we appreciate your support.
Absolutely. Have a wonderful day.